I'm Matt Bichard here in New York City for NAREIT's REIT Week, the 2018 Investor Conference. Joining me today is Eric Frankel, Senior Analyst with Green Street Advisors. Eric, thanks so much for joining us.
Thanks for having me.
Now, recently there's been increased M&A activity in the industrial sector. Can you speak to these deals and the implications for industrial asset values?
Well, there's a couple different rationale for the deals that have taken place, but it definitely speaks to really amazing institutional investor demand. So, from the Prologis and DCT deal, that was a bet on scale for Prologis, where they think there's some operational efficiencies that they can take advantage of given the overlap in the portfolio. There was a deal of Blackstone buying Gramercy for about $7.5 billion, and that's a big bet that asset values are going to keep going up. And so I think a lot of investors are seeing that, especially given how cap rates have trended low over the last couple of years and rents have trended up, and I think a lot of investors seeing that trend generally continue.
And what is Green Street's overall outlook for industrial demand over the next few years?
It seems like more of the same. There's some pretty spectacular tailwinds that are probably going to continue over the next few years. Generally, e-commerce is still a pretty terrific demand driver, and given that e-commerce penetration is relatively low and supply chains are still adjusting, there's still probably several years of the rebuilding of supply chains that have to take place, which is going to equate to more warehouse demand. So our forecast, where we've seen MRevPAF growth, which is a combination of occupancy and market rent growth, we've seen that be in the 4 to 6% range nationally over the last few years. We generally expect that to continue. The demand is still great and supply is relatively in check.
Now, of course, more demand typically means also increased supply. So with such continued robust demand like you're expecting, what should market participants be expecting in terms of the supply side?
Sure. So the reason why we have a pretty healthy MRevPAF growth or market rent growth forecast is that supply is relatively in check. And so there are a couple of circumstances and characteristics of the market that are a little bit different than past cycles. And so with the reconfiguration of supply chains, you're seeing tenants, they need to be closer to people. So whether it's end consumers in terms of where goods are delivered to, and labor in terms of people that are working in the warehouses. And so those characteristics means that you need to be in close, and you need to be in large population centers, and the land to occupy, the land where those warehouses are located are generally a lot more expensive to build, and the rents are a lot higher. They're willing to pay that because they can reduce other costs, but as a result of that, it's harder to develop those properties. And the entitlement time period is longer, and it costs a lot more. So therefore, you're just going to see it's going to be harder to add supply going forward, and that's what's buffeting our rent growth forecast.
And lastly, Green Street's conducted unique research on the intersection of industrial and retail assets, analyzing supply chains of retailers and logistic companies as they further evolve to accommodate all of these e-commerce trends. Can you describe the key findings and what investors can take away to help gauge future warehouse demand?
You know, there's definitely been a bit of a confluence in the retail and industrial sectors the last few years. And so in retail, when you're thinking about the profitability of a shopping center, you're thinking about the sales productivity of the tenants in those shopping centers. And so we've looked at the same for warehouses, because we're realizing that, you know, if you want to be a good supply chain, you have to be really efficient. And so you're looking at, okay, what are tenants doing in terms of their sales productivity? How much product is actually flowing through their warehouses? And so Amazon's a terrific case study in learning of how the industrial tenants are adapting. And so their sales productivity in their warehouses is about $1,300 per square foot. And that's super efficient for a shopping center. We can see that generally improving over time, but what that also equates to, that $1,300 per square foot, it also means that rent is a really low percentage of their revenue. You know, the occupancy cost ratio of a shopping center tends to be in the double digits. That occupancy cost ratio for Amazon is only about 1%. So that means that if they can reduce their costs, whether it's labor, whether it's transportation, whether it's inventory, by having more and better functional warehouses, then they'd be willing to pay more in rent. And so that's a trend that we're trying to understand, and we're trying to see where that occupancy cost ratio for industrial might go in the future.
Great. Eric, thank you so much for joining us.
Thanks for having me.
For more from NAREIT's REIT Week, be sure to visit NAREIT's website, REIT.com.